Good afternoon, everyone, and welcome to our seminar on protecting your most valuable asset, the ins and outs of property insurance. And I'm really excited about our speaker today, Paul Nadler. He is a third-generation insurance broker and has 42 years, I believe, of experience, or
47.
47 years of experience.
Uh,
So really excited to have him join us today, and happy to have people here. Before we go into the heart of the topic today, I like to do a brief real estate market update. Mm. The first topic here, this chart here shows median sale prices of single family homes in San Mateo County since 1999. And as you can see, this big red vertical line marks where we had the COVID lockdown or shelter in place happening. And then soon after that, there was a little bit of a drop, but then soon after that, in 2021 and the beginning part of 2022, we did see a pretty big spike in terms of sale prices. Since then, for the median sale price for April was at 1.78 million. So that's right here, 1.78 million, which is down from last year because last year we were seeing the highs and peaked at 2.25 million. But it is still significantly higher than it was even before COVID. So it's almost like you can take out this bleep here. And just as a reminder, the median sale price is basically the number that you get to the number of houses selling above that price are the same as the number of houses selling below that price. And so I used to get really mind boggled back when I started Perisson, we're at 1 million and we thought, well, median sale price is at $1 million. And since then, it's still 1.78 is still significantly higher than what we had pre-COVID. And so if you kind of don't worry about that blip so much, the steady rise or steady or not so steady rise of prices in real estate just continue on. What is the biggest factor in that? I would say inventory. And here we have a graph on the months of inventory. What this does is measure if you take all the houses that are currently on the market, and then what is the rate at which they've been selling recently, how long would it take us to run out? And the measure of that, if you have 6 months worth of inventory, that's considered our general balanced market. That's that green horizontal line here. And then if you're below that, that's considered a seller's market, and above that is a buyer's market. And so, as you can see, this 2008, this is that last great recession that we had. We did go into a buyer's market, had a lot of inventory on the market because it was taking a long time for homes to sell. Since then, since about 2012, we've been hovering at about the 2 month mark. And as you can see, as I mentioned, 2021, 2020, early part of 2022, the market was really peaking and spiking. And so the inventory levels were ranging around the 1 month level. Since then, it's gone up a little bit, and I'm sure people were saying, toward the end of last year, we were saying, oh, the housing market's going to fall and whatnot. It's held pretty steady, and we're still steadily around that 2 month mark, which again is traditionally known as the seller's market. And that's at the 1.9 months of inventory. So there are people talking about, are we shifting to a buyer's market? I don't think we ever even close to that necessarily, but it was getting slow at the end of last year and beginning of this year, where things were taking a little bit longer to sell. And so it was a little more of a not quite a seller's market. We've seen that change just over the course of the last month because there's not a lot of, the main thing is there's just not a lot of new inventory that's been clearing up. In San Mateo County, the number of new listings in April were about ranging between, depending on which category and areas, ranging between 30 and 40% lower. So 30 and 40% less new inventory than it was last year. And so inventory, I think, continues to be really the big factor of the day. Yes, there are interest rate fluctuations. Yes, there's talk of recession, the bank failures, whatnot. Across the board, everything that I'm reading, inventory is really what's going to be the main factor, and that's what's keeping our house prices still relatively high. And we're still getting the multiple offer situations where they had come back toward November, December, January. We were seeing less of the multiple offers. those situations have come back quite a bit over the last month or two, just because there's not a lot. So, and the buyer demand is still there. There are people who still want to buy and have adjusted to the interest rates being at more like 5, 6, or 7%. So this continues to be the main factor. And then the median days to sell, this has to do with once a house gets put on the market, how long does it take to get into contract, have an accepted offer? This red line here is COVID, and the counting days were actually paused during that time. So that's why it's at 0. It's not that all houses were selling quickly. And as you can see, it's, toward the end of last year, beginning of this year, it did go up to where we're counting close to 30 days, of 26 days was the highest in December for a house to sell. Since then, that has come back down, and for April was at 11 days on market on average. So we're seeing it take 1 to 2 weeks to get into contract for a home. And again, that has a lot to do with the inventory factor. So with that, I'm just going to go straight on to, I'd like to go ahead and introduce Paul. Paul Nadler is a broker, a third generation broker, has been in the business for 47 years. I'm really excited to have him because insurance can be a complicated, complex subject, something that it's similar to taxes, something that people don't want to think about too much until you really have to. But unfortunately, insurance is also one of those things where you should think about it before you actually need it. And so I'm really excited to have Paul with us today, and I would like to go ahead and turn it over to him.
Well, thank you.
Thank you for
Yes,
being
prevention is the best protection. So it's always wise to think about it ahead of time. So main topic is home insurance. And so home insurance, we arrive at that based on the square footage of your home and the style of the construction. So typically in the Bay Area, we're figuring replacement cost of the home to be $350 a square foot to maybe as high as $500 a square foot. So today, with such tools online with Google, and you could put in a home address and it will tell you, generally speaking, what the square footage is of your home. And that's what we'll use, because when we ask a buyer or the existing homeowner, do you know what the square footage of your home is? I think half the people don't know. And so then I'll look it up online. I'll say, online says it's 2,000 square feet. Does that sound right to you? And they'll confirm it. And then with the various tools from the different insurance companies we represent, we'll plug in the features that the home has, and it will come up with the replacement cost. So most carriers that my agency represents, and we're independent agents, and we deal with over 25 different homeowner carriers, will provide up to 150% replacement cost. So we always want to insure a home 100% to value. And then we have that extra kicker of 50%, and which during the COVID crisis was important because supply and demand of labor and materials has really driven up costs of construction. So any of you that have done remodeling and have gotten bids to put in a new bathroom or redo your kitchen or a new roof, you get shocked with that sticker shock, what it costs. And then when you find out you need to go get a dishwasher and they can't get you the one you want for 3 months, that also is a big surprise. So I'm waiting on a dishwasher at this moment. I think I got another month to go. So once we arrive at the dwelling amount, which we call coverage A, then on a homeowner's policy, you have 4 main parts. You have coverage B, other structures, anything detached from the house. Typical on a homeowner's policy is 10%. So typically around here on the peninsula, that's fine. But if you have a detached garage or an ADU unit or a pool house, something detached, you possibly will need additional coverage in coverage B, and that can be increased. And then coverage C is your personal property, and any good agent would give you replacement cost coverage. And most carriers will give you 70% of the building amount. So say if your home is insured for $500,000, they would give you 70% of that $500,000 for your personal property at replacement cost. So when a when you have a theft loss or a fire loss, the insurance company standardly will pay you the depreciated amount on that contents. Then you go out and replace it. You furnish the insurance company with the receipt showing you replace that TV that they gave you $500, cost $1,000. They then give you a supplemental check to replace you what the whole cost is. Bottom line, your deductible would come into play for the bottom line of the claim. Okay. Additional living expense typically is 20% of the building amount, depending on the carrier. Most carriers offer 1 year additional living expense. Some now will offer 2 years. It's important if you can to get 2 years, because with the construction crisis that we're going in now, it takes longer to get labor and materials to get the contractor to start your job. And it might take you more than a year to rebuild a house if you had a nasty fire.
And what does living expenses mean? What does that cover?
So let's say the home's insured for, again, 500,000, to pick an easy number. 20% of 500,000 is 100,000. Then you would take that 100,000, divide it by 12, and come up with 1/12. And that's the most they would pay you monthly to go live somewhere else. So you have money to live somewhere else because you're still going to have to keep on paying the bank, even though your house might not be able to live in because of the fire, but you still have the mortgage to pay. So that way you don't have to double the mortgage and paying rent somewhere. Okay. And they potentially could be picking up some extra meal costs that you have to eat out because you can't eat at home. So there'll be other things we'll cover in that additional living expense. Okay. Then item E is liability. Most policies today have a minimum of 300,000. Most carriers will offer you to buy 500,000 or $1 million of liability on your homeowner's policy. To go from 300,000 to 500,000 typically is about $20 more for a whole year. So pennies. To go up to $1 million might be $50 more a year. So if your carrier offers it, I would recommend it. Medical payments would be coverage F. It's very common. There's 1,000, 2,000. If somebody gets hurt on your property and they're injured more than 1,000, 2,000, or if you have 5,000, they're going to sue you. And that's where your liability is going to come into play. So I've had claims over the years where somebody fell on somebody's sidewalk and sued them, or they had a barbecue in their backyard and somebody fell down in their backyard and broke a leg. So it's important to have liability. Okay. These same coverages are similar when it's a rental property, a dwelling fire policy. You would have the dwelling amount. You would want to have replacement cost coverage again. You'd want to have some contents. You'd want to have liability. And in particular, in the rental, you want to make sure you have personal injury endorsement, because personal injury covers wrongful eviction. So personal injury. Okay. When you're looking to buy a house or put your house on the market, insurance companies, what they want to see is that the home has been updated with copper plumbing, with circuit breakers, that the furnace and the roof are newer than 20 years old. Insurance companies today don't like wood shake roof in California. So if you have one and you're thinking of changing your roof, go to composition shingle, because it seems like every carrier will accept the composition shingle. In California, because of all the wildfires we've had over the last 5 years, it has made the marketplace tougher to insure. And depending on where different people live in the Bay Area, they may have been impacted by wildfire. Even here in San Carlos, Redwood City, Hillsborough, San Mateo, there are different pockets that the insurance industry says it's prone to potentially of a wildfire. We've never had one on the peninsula, but they're playing conservative, and the majority of the industry is saying, no, we won't write there.
So
If we can't write it with a standard market, we have a couple of options. There's a product called California Fair Plan that writes fire insurance. And then we buy a sister policy called a difference in condition, a DIC. The Fair Plan, again, is fire on the house, fire on the contents. And then we would do a liability policy on the DIC with theft coverage on the contents. And that can get very pricey, where a standard product might be $2,000 for the home. If we have to do a fair plan policy and a DIC, it could be anywhere from $4,000 to $10,000, all depending on where the location is. That getting up in the Lake Tahoe area, it gets very crazy, the fire rates.
And have you also seen a lot of issues with all the winter storms that happen?
The winter storms, most of that has caused damage as far as windstorm, fences, roof claims, trees down, and most of that stuff is covered. What isn't covered in a standard home policy is flooding, surface water. So if you're now worried an area where you live potentially is going to get flooded, you would need to buy a separate flood policy. And there, besides FEMA, who's the federal government selling flood, there are independent companies selling flood. And that has become more competitive to buy it from the independent company than a FEMA product. We can sell both of them.
Okay, and going back to that point about when you're buying or selling a home, the insurance companies are looking like they don't like wood shake roofs, etc. Are there, what can a buyer do? Like, do they can they just go ahead and buy first and then update and hopefully get a better deal, or what would you recommend?
If they can get the house for the right money, I wouldn't make the insurance, kill the transaction, but maybe you could use it in negotiating and get the price you want. And then I most likely upgrade whatever need to be a upgrade, including the roof, and then probably reshop. Because most likely the carrier that accepted you with those conditions won't have a better rate. If you update the house, you'd have to go to a market now that is going to be excited that you have updated it, and they'll give you a better rate. Because unfortunately, the insurance companies file their rates with the Department of Insurance. And so they don't, in their rating structure, they don't have credits and debits if you have this or that. It's either, yes, here's our price, we'll either write it or we won't. So then we as brokers go to another carrier.
And you mentioned you're a broker, so you work with how many companies do you?
Probably 25 different home carriers, dwelling fire carriers. We do personal insurance, all kinds, commercial insurance, all kinds.
So how do you decide which company to go with for somebody?
We rate it with multiple carriers and see what fits best for our customer. We work for the customer, not for the insurance company. We have binding authorities with various companies. Again, if there's a claim, you report it to me and we're your advocate with the company. So it's not one policy that somebody's paying $1,000 or $2,000. We do millions of dollars in business with various companies. So we get to throw our weight around if we have to in working on a claim. So we're there all the way along the line.
That's good to know. And on the first bullet point here, how to make sure you have enough coverage. Do you see a lot of people who end up not having enough, and what, maybe sometimes it's because of cost. So what would be your thoughts on that?
My recommendation would be, if somebody hasn't evaluated, do they have enough coverage? Go ahead, call me. It's free. I'll be happy to give you my advice, what your home should be insured for. And I try to tell people, when it comes down to the price, I would rather see you have the right amount of coverage and play with your deductible to help reduce the price than to be underinsured, because there is a thing called co-insurance on a policy. And so if you do have a fire claim and you weren't insured to value, you could get a depreciated amount of money from the insurance company to pay you because you were underinsured.
Okay.
As an example, if you should have 100,000, but you had 80,000, and so now you have a loss for 50,000, you say, well, I got $80,000 worth of coverage, but I have 50,000. They should pay me the whole thing. They'll go, but no, you should have had it. You should have had 100, and because you're only insured 80% to value, we're only going to give you 80 cents on that 50,000 claim, so you're going to get like 40,000.
Oh, okay.
So it's a big shocker, and then the numbers are going to be a lot greater because your home's going to be worth well more than 100,000.
Right.
So it's important to insure to value.
To insure to value, and then you said play around with the deductible a bit.
Deductible to
So
help save price, as well as carriers today. See all the TV commercials for bundling.
Mhm.
Just about every carrier, if they do your home and they do your auto, they'll give you 15 to 20% off of each policy for writing the two policies. So it's good for you, it's good for them if they write both. And most of the carriers then too, if they'll write your home and your auto, they'll offer you a personal umbrella. So what is a personal umbrella? A personal umbrella is additional liability over your home and over your auto. So typically it's $1 million. So you buy 1 million, 2, 3, 4, 5, depending on your assets value. You know, if you have a bunch of money in the bank, you got stocks and bonds, you own other real estate. So there's reasons why you might buy more than 1 million. Or you could have young drivers in the household that are putting your assets at risk. That's another good reason to buy an umbrella.
I see. And someone asked, so you said insure to value. So maybe if you can clarify that a little bit more, what you mean by that.
So would you simple figure out what your square footage is of your home, and just for an easy number, use $350 a square foot. And so if it was 2,000 square feet at $350, if I'm doing the math right in my head, that's 700,000. So your home, not what it would sell for, it might sell for $2 million, but it should be insured for what it would cost if it burnt down to rebuild. So you'd want to make sure you're insured to value. And then most carriers that we represent would provide, if I insured it for 700,000, they would provide 150% of that coverage. So an additional 350,000 plus 7, so up to $1.05 million in a worst case scenario, which is important in today's day and age because of supply and demand of labor and materials. Our costs just keep on going up and up and up. So it's good to have that cushion.
So the 350, when you say that 350 per square foot, how are you coming up with that number? Is that kind of just a round number, or do the insurance
It's a
actually
round number from what we have seen from the replacement costs. Once we ask you a bunch of features on your home, each carrier we represent has a replacement costimator. We put in those features in their replacement costimator, and their system will give us a value. And so I try to use a round number to see, does that number come out close? Are they close to one another? And I'd rather be on the conservative side and a little more insurance to play safe than be underinsured.
Right. So when we're getting a quote, the insurance companies usually will have an estimate of what they think the value would be.
Right. What the home should be replaced at.
But then you can also look at that and go, does that make sense for this area? For I think you had mentioned before when we were talking, even the zip code can make a difference, right?
Correct. So, I mean, if we're picking on a home, say in Hillsborough, that typically has higher than 8-foot ceilings, maybe 10 or 12-foot ceilings. Well, might cost $500 a square foot to build there because you have that extra square footage height wise. You might have crown moldings, marble staircase. So you have all these different features that are going to cause the house to go up in cost. Today, I know in San Carlos, as an example, if you're building a home 2,500 square feet or more, the city of San Carlos makes you put fire sprinklers in a home. So if it's a newer home, you might have fire sprinklers. Most homes, I would say on the peninsula, don't, but you do get a credit for having fire sprinklers. Same thing in commercial buildings. When I bought the building I'm sitting in San Carlos, the magic number was if you bought a building that was 5,000 square feet or more, the new owner had to put in fire sprinklers. My building's 5,900 square feet, and 21 years ago, it cost me $80,000 to put in fire sprinklers.
Wow.
So that was a big surprise.
Yep. So, so if we can just move on to, there are other policies. You did mention a little bit umbrella, but we have that list. So
okay,
just go through those.
Valuable articles, floaters we would schedule. I'd recommend if you have jewelry that is worth more than $1,000 and you typically wear it every day, that would be something you'd want to get appraised and scheduled it. Jewelry, as a rule of thumb, costs roughly $16 per 1,000 to insure annually. But when you schedule something on jewelry, there's no depreciation, there's no deductible, mysterious disappearance. So I had a claim a few years back where a lady was bowling and she lost the main stone on her wedding ring. and we reported the claim. The carrier sent out a jeweler to her home, brought out 5 stones, showed her the 5 stones were comparable, if not better than the one she lost. The jeweler set it in a ring in her kitchen and told her, go to her favorite jeweler and ask him to reappraise this ring and see if he tells you it's worth as much as it was or more. And my customer called me back and said, Paul, I can't believe it. They were so nice. My ring is just as good, if not more. and that's why you schedule it. I had one just the other day where the lady had a $20,000 pair of diamond earrings. She went out for dinner. She lost one of the diamond earrings. So put in the claim, and the carrier then paid her so she could go buy a replacement diamond earring. So sometimes when it's like earrings, they'll say, give us the one and go buy a new pair if they can't get a pair to match. So they'll leave it up to the customer to decide. Okay. Flood insurance. I think I may have mentioned that earlier. There's FEMA and there's private markets out there. So if you do have to buy flood insurance, I would definitely shop flood, because FEMA is the federal government. Their rates are based on national exposure, not California exposure. And so we pay for the losses that happen on the East Coast. So FEMA, I feel, is too high for us here. The private carriers could be half of FEMA's price.
And what areas in this area have you seen that need flood insurance?
San Mateo Village area, San Mateo. I have a couple of customers in San Carlos that the lender required flood. Going down to Menlo Park, a couple of customers, but flood isn't that common. I want to say some customers that have rental property in Sacramento area. I've had to do flood insurance where they are located. See, how's that phone call? Okay, next topic, earthquake insurance. So there's private carriers offer earthquake insurance. In the state of California, the Department of Insurance tells every carrier that writes home insurance or rental properties or condos or renters, by law, they have to offer earthquake insurance. And if you don't buy it the first year, they have to offer it to you every other year by law. There's about 20 companies that make up the California Earthquake Authority. And so they're all in a big pool. And then other carriers write the earthquake insurance themselves. So earthquake insurance can vary in cost. I personally find it to be very expensive. You typically have a 15% deductible. So if you had that $700,000 homeowners policy, 15% of $700,000 is $100,000 and change that you would have as a deductible before they would pay. So roughly 10% of Californians buy earthquake insurance. My advice over the years has been a typical home costs $2,000 to $4,000 to retrofit. I feel that's an asset. Instead of paying $2,000 to $4,000 every year for earthquake insurance, then when you go to sell your house, you can tell the buyer, hey, my house has been earthquake retrofitted. Retrofitting means they put in additional foundation bolts. They put in shear walling, which could be plywood in your garage, or they could go in the attic and put in some metal straps. It just makes the house tighter and less likely to have damage in a quake.
Thanks for covering that, because that is a question I get a lot actually from people is, should I buy earthquake insurance? You know, especially being in the area they were in. So
right. Typically, most of our single family dwellings are detached and they're going to sway with the quake. If it's in San Francisco and they're row houses, they're one right against the other. It's important to have fire, because like the 1906 fire was because they didn't have any way to stop it. And it just, went one right to the next, to the next, to the next. We're here on the peninsula. Most of us are detached from our neighbors. And so if our house catches on fire, it's most likely not going to catch our neighbor's house on fire. So fire is the most important peril.
Got it. And then in umbrella insurance, you did talk about that a little bit, but can you explain a little bit more about that? And do you recommend it for everyone?
Yes. Okay. Picking on your home is your most important asset. Some of us have millions of dollars in equity in our homes, and So the umbrella starts off at $1 million and you buy however many millions you or your agent recommends, or maybe a financial planner tells you you need to buy this much umbrella. But an umbrella is on top of your primary insurance of your home and your auto. And so if you have young drivers in the household, that's a very good reason to buy at least 1 million umbrella. If you own some rental properties, it's also another reason. We can do an umbrella as a standalone. We have different markets that if I don't do your other insurance, I can still do an umbrella for you. If your carrier won't do an umbrella, or if you have one carrier for auto and one carrier for your home and need an umbrella, I can still do an umbrella.
And that covers what does that cover?
It's going to be $1
just
million
liability,
on top of minimum, on top of your auto limits. So typically your auto policy to qualify for the umbrella, you're going to need to have 250,000 per person bodily injury liability, 500,000 per occurrence. So if there's 2 or more people involved in the accident, up to 100,000 property damage, and then 250 to 500,000 uninsured motorist. So today, and it's not on the slide, but today in California, even though auto insurance is mandatory, there still is roughly 25% of the people driving cars on the road do not have California auto insurance. And then you find out when you get hit by them, oh, I don't have any coverage. So that's why uninsured motorist is very important. California law says you only have to have 15,000 per person, 30,000 per occurrence, but that protects the people in your car. And so if somebody hits you and you're injured and you're going to have all these extra medical bills, you sue yourself, in essence, all paper transaction to collect an uninsured motorist. If you get hit as a pedestrian, believe it or not, and you have auto insurance, your uninsured motorist coverage will protect you as a pedestrian getting hit by a car.
I see. And then so
I've
then
had claims like that.
umbrella insurance goes on top of that.
On
So
top of that,
it
and
doesn't
then
just cover, does it just cover liability, or does it cover
it's liability.
Okay.
Umbrella is only liability, and you do have an option to extend the liability also over uninsured motorists. So if you're a professional, such as a realtor, a doctor, a dentist, a lawyer, and you're out and about, and if you're in a nasty car accident and you're not going to be able to transact your job because of the injury, it's important to have increased uninsured motorists on the umbrella as well.
I see. So, and then property insurance, like the fire insurance, things like that, the property damage, you're assuming that that's already covered by your property insurance. Is that correct?
So from an auto property damage, lots of times people out there, California law says you have to have $5,000. A lot of younger people will buy $25,000, but you have to realize we're in an affluent area. Here in San Carlos, I probably see 10 Teslas in 10 minutes. And Teslas could be from 60,000 to 125,000. And so if somebody has low limits of property damage on their auto policy and they total out one of those cars, they're now going to come after them for their asset of their house or their pension plan or money in the bank to get that difference where they're underinsured. So I recommend to people that they carry at least 100,000 property damage on their auto policy. And then if you have an umbrella, then you'd have $1 million on top of that.
So that would cover property damage.
It would cover property damage in an auto accident. Yes.
How about for homes though? So if you have
homes, if you have 300,000 is their minimum requirement for an umbrella, and then you had $1 million umbrella, you'd have $1.3 million in a worst case claim.
So it could actually cover the property damage by fire as well. It's not just
not the property damage by fire. Well, if it became a liability because your house caught on fire and you damaged your neighbor's house,
right, then
it's a liability claim to the neighbor.
And then that could be covered by
right. But to fix your house, if you're underinsured, the umbrella is only liability.
Got it.
So it's if you injured somebody else because of the fire, then the liability would come into play.
So it seems like it's really important to kind of make sure you got the proper coverage and then have the umbrella to cover additional damage outside of just rebuilding your own house, having or restoring your own property. So
right.
Thank you for that. And then going on to investment and rental properties. So I know
investment properties, you want to make sure you insure them to value as well. You want to make sure you have loss of rents coverage. Most policies are going to give you 20% of the dwelling amount for the rents. So you want to look and see what that number is versus your rents, because our rents are kind of high on the peninsula. And so you want to make sure those numbers pencil out, that you have enough loss of rents coverage, because you can't increase that, and that's cheap. And it's also wise on investment property to have business personal property or personal property to cover stove, refrigerator, washer, dryer, because a very common claim is a kitchen fire. And so the fire policy, typically everybody worries about the structure, but the stove and the refrigerator typically aren't considered built in. They're considered personal property. And if you don't have contents coverage for that personal property, you'd have to pay for that out of pocket. And insure $10,000 worth of personal property on a rental might cost $30 a year. It's not expensive, so it's wise to have.
And then it also covers wrongful eviction.
Wrongful eviction, when you have an investment property, again, you want to make sure you have personal injury coverage. So if you own an apartment complex, you want to make sure that you have that personal injury endorsement. If your agent says, oh, that's excluded, you don't want that insurance company. You want another insurance company, because there are companies out there that today are excluding wrongful eviction, personal injury.
So if you see the personal injury clause, that's the wrongful eviction.
That means wrongful eviction, right?
If you do anything, okay.
And unfortunately in California, there's a lot of claims. And so that has been how some carriers have stayed in the market. No, we just won't offer that coverage.
And then how about for the tenants themselves? Do you recommend the tenants to have, or landlords to require it? Or
I recommend landlords to require the tenant to have renter's insurance. Typically a renter's policy could cost somebody anywhere from $150 to $300 a year, depending on the value of their own personal property that they're covering. And the rates vary by carrier. And it's a good way to save on your auto insurance. The carrier that writes your renter's insurance will give you a bundling discount for having renter's insurance and auto insurance.
And what would you recommend in terms of the amount to ask the tenant to get their insurance on?
I would ask the tenant to have at least 300,000 limits of liability.
Okay. And why is that important for the landlord, or we try to say housing provider? So why is it important for a housing provider? Why does that matter even to them too?
So the landlord is important, and it's important to get a copy of that policy from the tenant. So if the tenant leaves the property damaged, where they vandalize it, they poured, I had a guy change the oil on a motorcycle and on the carpet, and oil all over the carpet, and he left. So we filed a claim against his renter's policy that he vandalized the property. And then his renter's policy paid for a new carpet for my landlord. I had another one where the tenant they had Formica countertops, which you probably don't see that much anymore, but put a hot pot on the Formica and made a big black mark on it. So it had to get replaced. So we could go after the tenant's insurance company because we had a copy of that policy. Try to get the tenant to tell you after the fact is very hard.
Right. And I would just note in our standard California leases, the realtor leases agreements, it does have in there where you can require a tenant. And even if you're not using a standard California lease, just to make sure you have that requirement of the tenant having that insurance and also getting a copy of that policy. It sounds like that's really important to do. So,
right. And especially if the landlord allows them to have an animal in the house, such as a dog, because if it turns out if the dog bites somebody, the people end up suing everybody, and they're going to sue the landlord, they're going to sue the tenant. And so at least the landlord's first line of defense would be the tenant's policy before he or she would have to make a claim on their policy.
And then you did talk a little about animal liability. So do you have people often do that, or is that more for tenant situations? Or
it's on both home and rentals. Carriers ask what kind of dog somebody has in their household, and there are specific breeds of dogs that they will exclude on a homeowner's policy. I hear from people after the fact that they're calling me, my carrier is canceling my policy because my dog bit somebody and now they're non-renewing me. Can you help me? So there are companies that will, but of course it's going to cost more money if you still have that dog.
Got it. We do have a question that came in regarding, we've mentioned for the rental properties, the wrongful eviction, protection or personal injury protection. Can you go a little bit more into that and explain what that means?
Why?
What wrongful eviction, what does that have to do with?
Wrongful eviction could be your tenant, let's say, isn't paying the rent, and you just go tell them, hey, move your butt out of here. You're not paying your rent. You don't do the proper protocol where you have to give them a 3-day notice, and you didn't all do it in a timely fashion, or you discriminated against them. I had a claim one time where my landlord was an elderly person, lived in a duplex, upstairs, downstairs. She was on the downstairs. 2 young ladies were going to rent up above. And she said to the realtor showing the property, oh, I don't want them. They're young. They're going to make noise. Well, that's discrimination. They didn't even go for the place, but they turned around the next day and sued that little old lady for discrimination that she wouldn't rent to them. And the insurance company paid $20,000 to make them go away.
Wow.
Not renew their policy the next year, but
also important to keep fair housing practices in mind. That's important.
Right. So you have to watch, unfortunately, what you say. You think it, but don't say it.
Right. Well, I think also in California, the laws have gotten so much more tenant friendly, or protective of the tenants, and so in some cases it's easy for people to get into trouble without really, knowing it. So it's good to have that coverage.
Certain cities like San Francisco, there's more tenants than there are homeowners. So all the politicians, all the supervisors are all prone towards the tenant.
Right.
So,
and definitely in courts and whatnot, it's always a little more favorable of the tenant to protect tenants, because there are some needs for protection laws as well. But unfortunately, sometimes you'll get people who, who do, intentionally try to catch somebody who doesn't quite understand all the laws. There's a question about, so Margaret is asking, if I rent out a spare room in my home, what kind of a homeowner's rider do I need?
Well, if it's on a short-term basis, where some people are trying to do Airbnbs in their homes, most homeowners policies have an exclusion in there that it's not covered. So if you plan on renting a room, you want to call your insurance agent, and I would put it in writing, to them, maybe via an email, so you got an answer back in writing. Because if they tell you it's covered, and God forbid, then you have a claim, you can at least go back on here. I got in writing. My agent said, it's acceptable, and so I did it.
And what if it's just a long-term tenant you have in your room, not
then if we have to change it to a 2-family dwelling from a 1-family dwelling, typically that won't affect the price of the premium. We'll just make the insurance company aware that 2 families are living under this one roof.
Oh, okay. So you can do that.
But carriers don't want the Airbnb where somebody is here 3 days this week and 3 days next week and 2 months down the road. Carriers don't like that, because insurance companies are conservative. They want to know who that person is. And by doing the Airbnb, you have no clue who's going to rent it. And you hear the horror stories in the news where somebody threw a party and then somebody got killed at that party. And so the majority of the marketplace won't do that. There's just specific carriers that will do the Airbnb exposure.
Okay, so if somebody does have, because there are people who do Airbnb, so there are carriers out there that can insure it. I'm assuming it would be a little more expensive.
Yes. Yeah, because it is a bigger exposure, and there's more vacancies. A standard homeowners or landlord policy has a 30-day vacancy in it. So if your property is going to be vacant more than 30 days, you want to make sure one of your neighbors knows you're spending the night. So then you can break that 30-day vacancy. Okay,
got it. And then so related to that, ADUs, we haven't talked about that, or we don't have it on the slides, but accessory dwelling units, how do you handle that?
It could be an ADU, then could be added on as a second dwelling on the property. A homeowner's policy as well as a landlord policy has coverage B, other structures. And so then we would want to make sure coverage B has enough insurance coverage to replace that structure. God forbid it burned down. So typically coverage B automatically on the standard policy for the whole United States is 10% of the dwelling amount. So that's standard.
I see. It wouldn't be considered, because usually if you have an ADU, you have a tenant there or a second family there. So that wouldn't be a multi-dwelling. It would be.
It depends on the carrier. It could either be coverage B, other structures, or a carrier might make us write a separate landlord policy for that structure.
Right.
I've had it go both ways.
Sure, got it. And someone had a question regarding, Leanne had a question regarding the 30-day, you mentioned 30-day vacancy. And can you go explain that a little bit more?
Right. So in all standard home and dwelling fire landlord policies, there's a clause that says if the property is vacant for more than 30 days, their coverage is void. So if it's a single family dwelling, then you want to make sure you go spend the night or two there to avoid a 30-day vacancy, and just make sure somebody's aware that you were there. You know, pop a picture with your cell phone that shows the date and time on it. And you're in the kitchen, or I'm spending the night. So you got some kind of documentation, then you're not being void. But if it's let's say it's a 3-family dwelling and one of the units is vacant, that's fine. That's not going to void the policy.
So if somebody goes on a 2-month vacation in Europe or something, then they're not covered?
Let's say they did that, then I would go ask a friend or a family member to go stay in the house for a while.
That's interesting.
Because there's more apt that there's going to be a claim when it's that long-term vacancy. I've had several claims where a water line has burst inside the home. The people are away on vacation. They come home, their home is flooded because that water line broke. It seems like it didn't happen while they were there. Of course it happened while they were gone.
Yeah, water always knows when we're not here.
Right. I've had multiple claims like that over the years.
And how does that work then? If they were gone for a while, they're okay as long as it's not over 30 days?
The claims that I've had, they hadn't been gone, more than a week or so. And then it's amazing how many thousands, $50,000 to $100,000 worth of damage, because water just runs everywhere. It just keeps on going and going and going. Especially if it happens on the second floor and there's a lower floor that I have seen where it's made the ceiling fall. And if there's insulation, then you have wet insulation everywhere, and it's becomes a real big mess.
Yeah. And Joan is saying you should turn off the water if you're going to go away for a long time. I totally agree.
Right.
And can you speak kind of related to that mold issues? So is mold covered? Are mold issues covered if there needs to be repairs?
Most modern policies today, they put limitation on mold and mildew of $10,000 because it can get very expensive, a mold and mildew claim. So it's important to nip that in the bud.
Yeah, I mean, and $10,000 I don't think covers a lot. It doesn't go a long way.
Yeah, there are several water mitigation companies out there. The one that we recommend all the time is called Service Master. Service Master is a national franchise company, so all the locations are owned by somebody locally, but they all have to. They're like a McDonald's of restoration contractors. So they'll work 24/7. They'll come out and they'll suck up the water. They'll put down stuff to dehumidify a home. They'll do whatever they have to get it to try to get the mold and mildew from, nip it in the bud. And lots of times if it's carpet, they'll have to pull out the carpet and the pad so that the subfloor can dry out.
Right. Yeah. And water can cause a lot of damage.
Right.
Just going back to that 30-day vacancy, so that applies to all the main dwelling, not just rentals, right?
Whether it's a rental or a homeowners, yeah, either way, yeah.
Yep. And related to that, Joan was asking, which is really relevant to what I do a lot, is what if somebody either dies or moves away and the home is vacant for a while you're selling it, and Say it's on the market.
We can get a vacant policy.
Okay.
Lots of times that happens. In that situation, if it's going to be vacant, for months, the family wants to go in and clean up the house and then, maybe paint it and set it up. I just had one of those in Foster City, and we'll write a vacant building policy. They typically, they'll offer us coverage for 90 days, for 6 months or a year. And then after they put it on the market and sell it, then we cancel the policy and get a prorated discount back.
So that's, how does that compare in terms of cost? So is it worth it for somebody to do that? Or is it just more a matter of you can't be covered if it's?
Well, it covers your bases because you could get turned down by your carrier if there's a claim that, oh no, we're denying the claim because it was vacant.
Okay, well, that's good to
Right,
know, because
right.
I do have, sometimes people, or they move, you move out and you're preparing to sell and it might be empty for a while, while you're preparing it and then while it's on market. So
Right.
getting
More
that
things
vacancy
happen when they're vacant. I mean,
Yes, they
somebody
do.
could break in
Right.
and move in and destroy it. Yeah.
Right.
That-
And what about vacation homes? How, if you only use it a few times a year, how?
But on that
how's the
type of
handling?
policy, it's written as a secondary home. And so they understand there's a charge in there, knowing that's secondary, and they typically don't ask how many days you go there, but they know that there's going to be a lot of vacancy in a secondary.
I see. Okay. So there's that secondary policy to
Right,
keep in mind as well. So,
right. And typically we would write a secondary with whoever has your primary home.
so someone's asking, so if you go on vacation 2 to 3 months out of the year or something, do you need to get vacancy? Can you get vacancy?
If it's consecutive 2-3 months,
Right.
I would then get a house sitter or a relative to, stay at the house, at least a couple nights each month. So to break up the vacancy
and make sure
and have documentation.
Right.
Let them pick up your mail, let them pick up, your newspapers, make sure, because that's how a burglar is going to see, oh, there's mail in the mailbox for several days. Your newspapers haven't been picked up.
Right. So you can't just get a vacancy coverage. You would say just get a house.
Yeah. I mean, if you didn't rent it out or have a family member stay there, then I would go get a vacancy policy, especially if you knew it was going to be more than 30 days.
Oh, so you can get a vacancy policy.
Yeah, you can go buy a vacancy policy to cover that exposure.
Got it. Okay. And that's good to know, because the other question that came is, what if you don't have somebody or you don't want somebody to come in there? So that vacancy policy is an option to have during that time period.
Right.
Oh, good. I always learn something new from the seminars, and this is what I'm going to think about, in the future, because sometimes getting houses ready for market, they're empty for, good 2-3 months just to get ready, and not including the marketing period. So I think being aware of that is important. In the meantime, I do have Paul's information on the screen right now. If anybody has, if anybody has any needs and would like to maybe have him reach out to you and maybe you can reach out to Paul and have him do an evaluation of your insurance policies. And so I'll keep that up for a while. But
okay, I'm in San Carlos. I'm in the office every day, so just call and make an appointment, and I'll be happy to meet with you here. Or if you need me to come to you, I can come to you.
Thank you. And just as a final thing, what would be your advice for people when it comes to insurance? Like, what are some tips or some closing words you would have in terms of what people should not make sure to do or not do when it comes to
prevention is the best protection. So make sure all the debris, around is not around your house that could create a fire hazard. No tree branches hanging over your roof. Look at your sidewalk to make sure it's not a trip and fall hazard, because surprisingly, the cities say, no, that's your responsibility. It's your home. Somebody fell in front of the house. They're suing you, not the city. The old days, the city would pay the claim. Today, it's against you. So make sure you don't have grease spots in your driveway that somebody could slip and fall on. Kitty litter is good for getting up the grease spot, believe it or not.
Okay, sure. and I think most importantly, I would say know your insurance policy. So what does it cover?
Right.
If someone's asking about,
we don't mind. I have 10, 12 employees that you call and you can ask questions. I'd rather give you advice, again, prevention,
Yeah.
or something for you to think about. Should you do this or should you do that? Should I buy this kind of car? What's it going to cost? Lots of times they already did it and you tell them, oh, wow. Well, yeah, you just bought an $80,000 car.
The
It's
insurance
going
is
to
going to
cost the
be
comprehensive and collision is
right.
based on the value of that car. And so your premium is going to go up. So I don't mind people calling me and what if.
So thank you again and wish you a great afternoon.
Thank you.